Let me see if I can do that. I'll see how that goes. So anyways, in terms of the economic impact of coronavirus, um, the economic recovery can take very different, um, different forms. And this is just a little bit of history on some of the different impacts of economic recoveries during the past um, recessions. So in Canada, back in 2008, when we had a recession, there was we call it a V-shaped recovery because the economic condition went down and then it sort of bounced back up quickly because the government interacted quite quickly. In the United States, they had a longer, prolonged recession back in 2008 during the mortgage crisis. It took them a little bit longer to get back into their regular economic trajectory. So that was deemed more of a U-shaped recovery. And then, for example, in Greece in the last recession in 2008, it took them a lot longer to recover. So they sort of had a low economic impact, and then it took them a lot longer to recover. So we called it an L-shaped recovery because it went down and then to the right. Now, in this particular case, we've seen more of a K-shaped recovery where some of the economy globally and locally has recovered and gone up, but a lot of the other industries have not recovered and they've gone down. So that's sort of some of the big picture macroeconomic things that we're seeing in terms of the global economy. The job market in Canada clearly had a major disruption in April when the unemployment rate jumped dramatically, and it has recovered quite a bit since April. So the blue area here is the decrease in the job market. So a lot of job losses in March and April. And then in May, June, July, August, and September, a lot of the jobs have recovered, which was great. But recently we've seen that drop down a little bit as we enter another lockdown period recently in late December and early January. So we're monitoring that as well. Now, in terms of healthcare, dentists and the economic and job market has actually recovered quite well compared to other industries, including medicine and most other healthcare practitioners. You've got a major bounce back in terms of the employment sector. And a lot of dental offices are back into over 90% recovery in terms of their job practice staffing, whether it's assistants, front desk, dentists themselves. There has been a good, stable recovery in the dental industry. And one of the factors that were issues that we had in the past was early on in the pandemic was issues surrounding PPE. A lot of that has also recovered quite well, where that hasn't become a major factor. And the general public is also more prepared and ready to go back to the dentist based on current surveys in the market. There was one here done in August of 2020 where 52% of people were ready to go back to the dentist, and less of them were interested in going back. There were 15% were looking for like a medical breakthrough before considering going back for a dentist appointment. But recently, the same survey indicated that more people were ready to go back and less people were concerned about a major medical breakthrough in order to recover or to return back to the dentist. So that has helped the industry recover quite well compared to some other industries in other industries in different sectors. In terms of the percentage of people that believe that dentistry should stay open during a lockdown period, that has also been quite high at 71% of people interested in dentists remaining open. Grocery stores, pharmacies, and dental offices and medical offices being on the high end of areas where the general public has thought that remaining open to the general public would be a good thing. In terms of the rebound of production, clearly during March, April, May of 2020, 2020, during the lockdown period, there was a major disruption in the dental production, and that has improved quite well and recovered into 2021. In terms of the dental industry in Ontario, the dentist to population ratio continues to be concerning in some areas of the metropolitan areas where there's a large incidences of but in other areas outside of the rural areas, outside of the city areas, there tends to be less dentists, and the dentist to population ratio tends to be a lot higher. For example, in Toronto, there's about 900 dentists, 900 people, sorry, for every dentist. Whereas in certain other regions in Ontario, for example, you got 3,000 people for every dentist, or 3,500 people for every dentist. So the distribution of dentists still tends to be in the city rural areas. Some of the other factors that we've seen comparing the city areas to the northern areas, there's a lot more higher incidences of days booked ahead in the northern regions compared to the city of Toronto, for example. There's a lot more hygiene booked ahead in the northern areas, almost double than the Toronto region. The number of hours worked by the average dentist is a lot higher than the northern region as well. Even though they're a lot busier, they tend to work a little bit less. And that's partly because of competition, and they're not open as frequently, for example, on weekends or whatnot, because it's less competitive. Average hygiene hours way higher in northern regions than in Toronto. Again, because of just the incidences of caries, and the fluoride in the water can impact northern regions differently than in the cities. In terms of economic impacts, there's a new book that was just published called Apollo's Arrow, which talks about the social and economic impact of COVID-19 and how it affects, how it's affecting our social and economic economy currently. And it does talk about the impact of different outbreaks and variants of COVID-19. So, it's important to keep that, in mind when you're navigating through your particular situation. So that's just a general economic update. And at the beginning of this crisis, there was a lot of chaos. And one thing about chaos is it can make you uncomfortable in modern chaos theory, but it can also allow you to be creative and be an impetus for allowing for growth in your business. So it's important that when there is chaos in the dental industry, use your network, identify it as a market opportunity, find a mentor or a dentist that you work with that can help you through, whether it's looking for a position or looking for advice or advancement, or looking for other help during this time. Join a dental study club, maintain flexibility in your options, analyze the demographics of your area that you're working in, be creative. And for those of you that out there who are dental associates or recent grads or those who are graduating in June, a lot of students have looked at different options in terms of GPR options, in terms of improving their education as they move through the process, as well as the advanced education general dentistry programs in the United States. So there are different ways of pivoting depending on how comfortable you are in your career path at this time. For those of you that are associating or starting an associateship, it's important to look at different considerations in the process, whether it's signing the agreement, looking for mentorship, competition clauses in your agreement, radius clauses. There's various different issues that come up when you're signing an associateship agreement. So it's important for you to look at these factors and keep these in mind when you're about to get into an associateship position. For those of you that are already in an associateship position, you can, and you may be looking for a second or third associate position, these issues do come up frequently in your associateship contracts, whether vacations included, non-solicitation, profit sharing possibilities, formulas for buy-in provisions, possibly if it's a entrepreneurial type office, the terms of the agreement, the culture of the staff, co-pay assignment issues in the office, and just the general working of the office in terms of how they're operating as a system can make a major impact in your decision on your associateship that you're taking on. So just general high-level advice for those of you that are looking to sign associateship contracts in terms of some issues that do come up. So that was just a general economic update that we've seen in the dental industry, as well as some high-level issues that affect associates. If anyone has any questions so far, looks okay. Oh, thank you. Who's coughing? Can they mute themselves? Yeah, hopefully. I haven't heard a cough in a few minutes, so hopefully that's been resolved. Can we have some of the participants mute their mics? Yeah, thank you, Sagar, for that. And we're going to access to the presentation slides at the end. Yes, Natasha, thank you. We can definitely arrange for that. If you can, at the end, I'll send you my email address and we'll get those seminar slides over to you. I've attempted to record the session. So if that goes well, I will be able to post this on our website as well and our YouTube channel, just so that those of you that couldn't make it or would like to review again, we will review. You'll be able to review this, at your leisure. So, tax season planning. Okay, so this is an excerpt from a letter that we send out to our clients that summarize some of the issues that come up during tax season. So I kind of data dumped it here, but I just wanted to go over it with you quickly, just to highlight some high level issues that do come up that you need to consider when you do your tax return. So let's go through this quickly. All right. If you're making an RSP contribution, the deadline to make a contribution is March 1st. Please note that the CRA electronic filing network is undergoing the annual maintenance, and they'll reopen on February 22nd, which is tomorrow. So that's for those of you that are ready to file your tax return, the first time you can file your tax return in Canada will be tomorrow. RSP contribution deadline, again, is March 1st. This means you have until that date to make an RSP contribution that will allow you to make a deduction for your 2020 tax return. So for those of you that have been associating for a while, which you see later on in the presentation, it could become a significant benefit for you to look at your RSP contribution room and make that deduction before March 1st in order to claim that deduction on your 2020 tax return. General filing deadline is Friday, April 30th. If you're self-employed, which most dentists are, and if you're married, your spouse will also get the automatic extension to June 15th to actually file your return, so you won't get charged a penalty. But if you owe money to the government, you have to pay it by April 30th of 2021, regardless of whether you're self-employed or not. If you file after the due date of April 30th, if you're not self-employed, or June 15th, if you're self-employed, then the government has a penalty provision that they'll charge a penalty for late filing. For those of you that are dental students, don't worry, there's no filing penalty if you don't have any income. So if you can't file on time, I know that some of you are going through exams right now, and it's a busy time. So if you don't have any income and you file after the deadline, there's no penalty. HST doesn't really apply to dentistry, as most dentists are HST exempt. However, for those of you that are doing other services that are HST eligible outside of your dentistry, then you would also have to file your HST return by June 15th as well, and pay any HST collected by April 30th. If you have any balance owing and you do not file on time, the penalty is 5% of your balance owing on the due date of your return, plus 1% of the balance owing for every full month, so a maximum of 12 months. So the maximum penalty for filing a late tax return is 17%. So it's 5% plus 1% of each balance owing for a maximum of 12 months. So 12 plus 5, 17%. So pretty harsh penalties the government has implemented in the event that you do file late. They will, and you owe taxes, and you file it after the payment deadline of April 30th, they can charge a 17% penalty, which means, so let's say you owe $10,000 in tax and you file late, there'll be a $1,700 penalty. If you file after 12 months. So it really depends on how late you file, but hopefully you file on time. So for those of you that are engaging a firm or an accountant to do your taxes, some of the things that you'll need to provide them, for example, will be any tax slips that you receive, whether it's T4s, T3s, T4. These are all different codes that the government has for different types of income slips that get generated to individuals. Most dental students, if you are in school or you recently graduated, will have a T2202A tuition credit slip, which will be provided by your university. For those of you that studied outside of Canada, you may also be eligible to claim your tuition credit. You'll have to get a special form for that. If you have any receipts for professional dues, dental tools and expenses that you claimed, medical expenses, charitable donations, these are different tax credits that are available. In order to be eligible for those tax credits, you will need to provide supporting documentation for those. Moving expenses can come up as well for those of you that had moved in order to take on a full-time position at a dental clinic or to take on to study full-time. Interest on your student loans. It's another area that you want to look at getting those that information from OSAP, for example. If you're in Ontario, you can deduct the interest and any other interest and expenses incurred to earn investment income, which we'll get into later. Exam fees, for those of you that are involved in national board exam fees, those are eligible for deduction. Childcare expenses. What else is here? There is an income and expense worksheet, which we're going to go through later, which is going to have a summary of all the different deductions that you can claim as well. What else is in here? Other things, if you had a change in your marital status, you'll need to provide the date of the change plus the date, the name and the income of the other individual. So if you were married in 2020, you'll have to change your marital status, indicate the date of the change in the status, as well as provide the income on that person's return, even if they're filing separately, because that can affect certain personal tax credits. If you had a child in 2020, you can provide their date of birth, their name, and their social insurance number. That'll allow you to be eligible for some child tax benefit credits, and also will be required for purposes of deducting the childcare expense. If you have a new address, you're going to provide us that. New position, new job. If you purchased a first-time home in 2020, you'll be eligible for certain tax credits. If you have any foreign property outside of Canada, and the cost of that property was over $100,000, there's special reporting requirements for that. We'll go into that a little later. If you changed your car or had a new vehicle in the year, you'll have to organize that information as well. And any information that you received from CRA, you want to make sure you put that in your folder, whether it was a notice of assessment or a letter or correspondence. Sometimes that can be impactful to understanding your tax situation. It's just some new things that have come up for those of you that are happen to be employed during the year. There's a home office deduction that's available for all Canadians that were required to work from home for more than 50% of the time. So the government has provided a simple method as well as a more detailed method in order to calculate the home office deduction. So if you use the simple method, it's $2 for each day that you worked at home. If you use the more detailed method, you can actually provide your actual expenses of your house, then they'll be prorated for the percentage of the home that was used for home office, whether it's square footage of the house, total square footage, and then the square footage of the home office portion, or the number of rooms in the house and then the number of rooms that you're using. If you do that and you are employed, if for some reason you were employed, not as a self-employed in 2020, then you have to get your employer to fill out a form. And it's called the T2200S. And it allows you to then go ahead and deduct those expenses. The other thing that to be mindful of is for those of you that receive CERB, the Canada Emergency Response Benefit, those benefits are all taxable and will be included in your income. You should have received a T4A slip from the Canada Revenue Agency, and on box 197 of the slip, it'll indicate your amount of money that you received. If you did not receive the slip, you can log into CRA, your My Account, which will show you how to register for a little later, and you can actually download the slip and go from there. Now, keep in mind that the Canada Revenue Agency did not deduct any taxes from that income. So it was approximately $2,000 a month. So I believe the maximum amount was 7 months. So it would have been about $14,000 that the person would have received. And then they have to include that in their income. So they may actually have to pay tax in it, depending on their income bracket. So definitely keep that in mind when you file your return. For those of you that have professional corporations that, or you may have been self-employed and also been eligible for the Canada Emergency Business Account benefit, which was the $40,000 loan that was provided to small business owners in 2020, of which 10,000 of it was forgivable. The $10,000 portion is taxable at the time of receipt. So you have to include that in your income in 2020 as part of your filing. So please keep that in mind. For those of you that may have received the additional bump, which was an additional $20,000 CBA benefit, of which $10,000 was also forgivable, you also have to include that $10,000 into your income as part of your tax filing. So keep that in mind for you CBA, Canada Emergency Business Account individuals that receive that. CRA fraud warning. CRA is warning Canadians that fraudulent emails, phone calls, text perpetrating from the Canada Revenue Agency are currently being reported. So just FYI, be careful for that. CRA will not generally send emails. They may call you in certain circumstances, but you can always get, what I recommend is to get the agent badge number of the individual, and then you can call them back. And then you can also verify their badge number directly with the Canada Revenue Agency if you think that's a suspicious reason that they're contacting you. CRA My Account, I'm going to go through a quick video later on in the session where you will be able to access the, show you how to register for that, for those of you who have not. And CRA also has an app that you can download on your phone, which allows small businesses and sole proprietors to view their account balances, make payments, and do some other things on your phone. It'll also remind you of some deadlines and things like that. If you do go online, there's also online mail that you can access directly. So if you moved or something, at least you know that your online mail will be there for you online. For those of you that are first-time homebuyers, you will have to disclose that if you made a contribution to the home buyers plan in 2020. I'm going to go into a little bit more detail about that a little later, but you do have to report that on your return because there's a mechanism where you have to repay the home buyers plan back over a 15-year period at a minimum. So keep those high-level issues in mind when you're filing your tax return. Cannabis as a medical credit, for those of you that have any prescribed medical cannabis products, they're now able as a medical tax credit. That was new for last year. The Canada Workers Benefit still continues on, benefit available for working income tax benefits. And tax-free savings account has now increased as well. You don't have to report your tax-free savings account on your personal tax return, but just a FYI that the maximum amount that's available for contribution is $75,500 effective beginning of this year, depending on when you turn 18. And I'm going to go into a little bit more detail about that a little later as well. Okay. For those of you that are providing us with some bookkeeping information as part of your submission, we're going to be going over a income expense worksheet a little bit later. Make sure that you do keep all your receipts together. We don't need all your receipts, but you need to keep them in case the Canada Revenue Agency ever asks you for them. Quick tip here, take a picture of your mileage on your odometer, you know, at the beginning of the year and then the end of the year, just so you can document how many kilometers you drove during the year, or it'll help you when you're trying to submit the total kilometers you drove during the year. You can obtain a year-end report of all your expenses from your credit card company. Some companies do provide that. So definitely helpful if you can get your credit card company to, you know, organize that information as much as possible when you're doing your expense summaries. Download your mortgage statement from your bank. That's also helpful if you're claiming a portion of home office, which we'll go into later. And if you have any investments that you're doing, a lot of people are getting involved in stock trading and self-directed accounts. So for those of you that are trading in brokerage accounts outside of your registered accounts, so outside of your RSP or your TFSA, you need to make sure you keep all your trading information. Keep all your receipts and documents for at least 6 years. So after you file your return, you still need to keep your records for 6 years after the filing, in case the government ever asks for the receipts. So it's important that you keep your receipts, even though you've already filed your return. Point there too is that the government can only go back and audit a particular year 3 years after the date of the notice of assessment. So they can't open up a request for information 3 years after that date of your filing of and the receipt of the notice of assessment. So there is some statute barred provisions in terms of how far back they can go. The reason we tell and advise people to keep their records for 6 years is because if the government was to open up an audit on a taxpayer and they found a problem, they can go back 6 years if there's something that's false or misleading. Okay. Generally, though, they can't go back more than 3 years from the date of the assessment. So that's just an excerpt from a letter that we send out to some of our clients. So personal tax checklist. Yeah, on the resources page of our website, you can actually download a personal tax checklist. I'll swing over to a screen share to our office website later on in the presentation, and then we can take a look at that checklist. Okay, so setting up CRA online access. So I'm just going to, I'm going to stop. I'm just going to start a quick video where we can just show you guys quickly how to set that up. Give me 1 second. It's going to go to the video. Give me a second while I set that up.
This is my.
Okay. All right. Let me go back to my screen share here. Okay, so here's a quick video on how to set up your online CRA registration for your personal account, okay? Quick video.
This is Mike. Mike likes to do things the easy way. Recently, Mike read that My Account, the Canada Revenue Agency's secure portal, lets Canadians across the country view and manage their tax and benefit affairs quickly, conveniently, and securely, all online. Mike thinks this seems like a good idea. So, he found a quiet spot on his lunch break and engaged the power of technology to help him manage his tax and benefit information. With a few clicks of his mouse and a few strokes of his keyboard, Mike began registering for My Account. Mike started at the My Account webpage at canada.ca/my-CRA-account. Mike has the option of choosing from 2 ways to register for My Account. He can register and create a CRA user ID and password, or he can log in using a sign-in partner. Mike uses online banking on a regular basis, so he chooses the sign-in partner option. He logs in with the information that he already uses with his bank, making his experience that much easier. After entering a few details to ensure his privacy is protected, like his social insurance number, date of birth, current postal code, and an amount from his last tax return, Mike has instant, secure access to some of his tax and benefit information, like the status of his tax return and a summary of his notice of assessment. He can also sign up for online mail. Within a week or two, Mike will receive a letter in the mail from the CRA with his CRA security code. Mike can also call the CRA to get his code earlier. Once Mike enters this code, he will have full access to even more information through My Account, including details about his tax returns and benefits. Now, Mike can do everything from updating his address, to checking on the status of his refund, to printing proof of income, to setting up direct deposit, and much more. He can also log in and check some of his information on the go using the My CRA web app. Now that's easy. If Mike used his security code to fully register for My Account, he can also use the CRA's autofill My Return service when he files online using certified software that includes that feature. Autofill My Return automatically fills in certain parts of his income tax and benefit return. What could be easier? But Mike thinks the best thing about My Account is that he can access the information he needs anytime, anywhere. Perfect for someone with such a busy life. Make your life easier and be like Mike. Sign up for My Account. You'll have access to the CRA's full suite of self-service options and see firsthand how the CRA is delivering on its commitment to client-focused service. Find out more at canada.ca/my-CRA-account.
Okay. Okay, that was the video. Hopefully that was insightful for people who didn't know about that service, but definitely something that you need to do, and it's very helpful.
If you're Canadian, then you
Yeah.
definitely need to sign up for the My Account from the Canada
Oh,
Revenue Agency.
what's this?
Or CRA for short.
Oops. Okay. So, as I was saying, very helpful to have the CRA My Account. It's a lot of times banks will ask for information about your notice of assessment and income and things like that. So it's very handy to have this setup. Now, as the accountant of record for our clients, we do have access to a program called Represent a Client, where we can also access similar information on behalf of our clients. So we do provide that service, but it is very convenient to have that at your fingertips, whether it's your tuition carry forward balances or your RSP deduction limits or your TFSA limits or access to your online mail. Definitely something to keep handy. So let me just double check if there's any questions so far before we go to the next section. We have some participants, okay. Question here, thanks for this presentation, hope you're doing well. Can Canadian education benefits be transferred and used in the United States? Okay, so I believe that's somebody who's in the United States and they want to use, generally, no. So if you're in the United States and you're in the US and you, for example, go to, let's say you're U of T, and then you decide you're going to go to California, the American government does not have a system to allow you to use those Canadian tax credits. They're lost. They're not expired. You can still use them when you come back, if you come back to Canada. So a little bit of a tax grab there. Now, the good news is if it's the other way around, and for those of you that studied in the United States, we have a lot of clients that have, they went to Boston or New York or whatnot, and they did dentistry, and then they came back to Canada. The Canadian government allows for those tuition credits to be reciprocated in Canada. So not sure why the US, question here, do I need to keep my gas receipts? Yes, you do. However, it never seen, I saw a case a few years ago, many years ago, where somebody was asked to provide some supporting documentation for their automobile claim.
To talk about all the tax credits and all that for
Yeah.
Dennis.
Marina, we hear you. But anyway, so yeah, keep your gas receipts. Well, the thing is, as I was saying, people who when the Canada Revenue Agency looks at your automobile expenses, there's different ways of calculating those credits. You can also use like an allowance method based on the kilometers that you drove, so you don't have to keep the receipts in that case. It's kind of like a simple method. To protect yourself, you should keep the gas receipts. The simple answer, I think, on that is that, and you guys to know this, is that if you go to a gas station, you can pretty much buy anything now. You can buy groceries, you can buy like, anything. So just because let's say your credit card statement says that you went to Petro-Canada and you spent $100 doesn't necessarily mean it was for gas. So that's something to consider in terms of keeping the receipts. What else do we have here? Can you put the link here for that checklist? Yes, I will definitely, at the tail end, I'll definitely show you the link for getting all these checklists. We have it on our website. I'll do a quick demo on that. What's the difference between a tax credit and a tax deduction? I'm going to be doing a demo of a tax return, and you will be able to see that. Generally, a tax deduction is directly written off on your income. So let's say your income was 100,000 and you get a tax deduction. It would be like 100,000 minus, let's say the deduction was $2,000. Like you made an RSP contribution, that $2,000 would get deducted directly from the 100. Whereas a tax credit is kind of like a coupon. It's a fixed amount, and you'll see the mechanics of that in the personal tax demo. I'll definitely talk about that in the demo. What is the basic personal amount, and is everyone eligible for it irrespective of our income? Yes, the basic personal amount is approximately $13,000, and everybody gets that credit. And when I do the demo, you will see a example of that in action in black and white. Also, do I need to save the checks of salary received as an associate? If yes, for how many years? Yes, I think you should save your records under the Health Act, which governs dentistry. That payment that you received, also not only for tax purposes, but also for your health records, you should keep your Health Act requirement, I believe, is 10 years, or you have to keep, clinical records as well as payment records are also part of your clinical payment. So I think you should keep all that stuff too. Are pictures of gas receipts okay, and does it need to be original? Yeah, pictures are okay. The government allows you to maintain electronic records of documents as long as you have a system in place to ensure that they're backed up. So yeah, you can keep electronic records. There's a few apps out there where you can actually just take a picture of the receipt and it'll just save it for you in a database. There's a few companies out there that do that. Where you can take a picture of the receipt. It'll actually use some little bit of AI technology to sort it for you and put it in a particular category, and then you can just destroy the receipt at that point. Thanks for information. Can I claim motor vehicle expenses on a vehicle that I use but do not own? That does happen quite often. Yes, you can, a portion of the expenses, because even though you don't own the vehicle, you may be paying for gas and other operating costs. So you may be able to claim a portion of that vehicle, even though you don't actually own the vehicle. Maybe not the capital cost of the vehicle, because that's owned by somebody else, but some of the operating expenses that you incurred, you could deduct as well. And I'm going to go through that in the demo. You'll see an example of the different categories. Okay. Oops. What's the best method to organize all my credit card expenses? I'm tired of typing them into Excel. How can I just import it all? Yeah, like that's a great question. There's actually technology out there and some apps out there and some softwares that are free where you can actually import information directly from your credit card statement and your bank account, and it'll actually organize it for you. So there's actually a few programs. One's called Wave that we do see some clients use. It's a Canadian company. It's a free software. It uploads the credit card and the bank information directly into the software program. The other one is QuickBooks. They have a function, QuickBooks Online, where you can basically set up your bank account directly with the software. It'll import everything every day automatically. And there's actually a rule provision built in where you can actually create a rule for a particular item. So let's say an item comes in from Henry Schein, you can classify it as a dental supply and automatically organize it into the dental supplies next time it imports it. So it'll import the ones that it recognizes. Like if it recognizes as a restaurant, it'll actually put it into the meals category. If it recognizes it as a gas item, it'll put it into the automobile gas expense. If it doesn't know what it is, it'll put it in sort of another category, and then you can then create a rule that's saying every time this receipt comes in next time, just put it into this category. So there are softwares out there that do that for you, and it's on cruise control. For many of our clients that are on, that even practice owners, we have them registered with QuickBooks Online, and even their practice credit card statements and bank statements are being imported directly into QuickBooks Online in certain cases. There's some security issues with that, but we haven't seen any problems because there's bank level security built into these software programs. But definitely the AI is definitely catching up. Somebody had mentioned, let's see here. Thank you. Can we only report meals that we've kept receipts of? If you didn't keep the receipt, you may have a credit card statement, and you could use that as a source of documentation, even though you don't have the original receipt because you have it on your credit card. There was a case recently where somebody was challenged. I read it in a tax publication, and the government had asked them for supporting documentation, and they had accepted the credit card receipts as adequate evidence, even though it's not the best line of defense. It does give you some information, the date of the transaction, the name of the payee, the name of the restaurant, etc. So definitely nice to keep the receipts. The chance of you being asked to provide receipts is very low. Generally, in terms of CRA audit, for what we've seen in terms of the healthcare industry, maybe 3%. But you got to keep the receipts, but try your best. You could probably recall based on your credit card, where you were and what the meal, what it was that you were involved in terms of the business part of that meal. Is there a difference in category write-off percentage of courses versus coaching? Not particularly. Not a different category. If the coaching is involved in somehow your business, then it should be in the same category as a course where it's 100% deductible. It wouldn't be part of tuition, but it'd be part of like continuing education or professional fees that you're paying, and 100% deductible if it's related to your business. What are the advantages of incorporating? When will it make sense? Great question. We do have we're going to be addressing that in the next chapter. QuickBooks and this is QuickBooks and Mint. Yeah, so Mint is another software. QuickBooks Online, we have been using that for many years. Mint, I personally don't have any experience working with, but I believe that's another software program that you can consider using to upload your income, your expenses, your bank information from online and categorizing it. Question, what if we haven't got paid for what we made the year before and get paid late in 2021 after we are supposed to file our tax returns? Yeah, that's a big point of confusion in some ways in the dental industry too, because there's the accrued basis of categorizing and the cash basis of categorizing. So in the Income Tax Act, it's not clearly defined, but Canada Revenue Agency has a position on that essentially says if you're self-employed, you're supposed to use the accrued basis of accounting, which means that you would have to include associate income in 2020, even though you were paid, let's say today. So it's February 21st, you got a check, but they paid you late. So you were supposed to be paid, it was actually like something you did in December. So technically you're supposed to include that on your personal tax return in 2020. That's called accrued basis. Now there is a carve-out provision in the Canada Revenue Agency guidance, which says that if you're self-employed and you're an agent that's being paid as a percentage, it doesn't say percentage, it actually says commission, but it says that then you can use the cash basis. So that's where it becomes a little bit gray because, okay, as an associate dentist, you're not necessarily paid on commission, but many of you are on a split. So some people take the position that because it's a split, it's considered available. You're considered to be eligible for the cash basis. Most of the times it's not material. It's not that you're not reporting the income. It's just a timing difference. So one workaround maybe simply just to ensure that your associateship contract maybe qualifies it as a agent amount, and then that's something you can talk to your principal about in terms of making sure that the contract with yourself and the principal dentist and the office indicates that you are going to be acting as an agent of the office and therefore eligible for the cash basis. It's a lot easier to use the cash basis because then you don't have to toggle between trying to figure out what did you include the year before, what did you include this year. So it can become very problematic for a lot of people and confusing because then it just becomes a big mess trying to figure out if they included that income in the prior year, and then they're digging up their records from January of 2020 in order to figure out if it was in 19 or not. So we can Tony, we can talk about that in more detail, maybe depending on your particular circumstance, but I would look at your contract and also for those of you that already filed your 2019 return and included it on the accrued basis, which means that in the payment that you received in January of 2020 and you already included it in 2019, make sure you don't double count it again, right? Otherwise you're paying tax twice. That's the risk. The other interesting thing about that question is that the expenses, it's the same thing. So if you ordered a supply and, it doesn't apply as much to associates, but let's say you took a course and for some reason you paid for it after, technically if it's accrued basis, it also applies to expenses. So if you paid for an expense in January on your credit card, but you purchased it in December, you could still deduct it in December. So the same concept would apply to the expenses. You can imagine how that can create a little bit of a hiccup in terms of calculating, because you'd have to look at your January 2021 credit card statement. And if you look at it, you'll notice that a lot of the transactions happened probably in December. And you didn't pay for that bill probably until the first, second, third week of January. So technically speaking, if you're using the accrued basis of accounting, you could deduct those expenses in 2020. Even though you paid for the credit card bill in 2021. So jury's out on that, but I think most of the clients that we deal with do it on a cash basis for simplicity purposes, and they take the position that they're covered under the self-employed agent criteria, as noted in the Canada Revenue Agency website. All right. If I get paid monthly as an associate, does my January paycheck for work done in December count as, okay, the same question. I filed my taxes online myself. I feel like I may not file correctly. and my tuition credit should be higher. Can I still adjust it? Yes, you can definitely go back and do a T1 adjustment, which is, and you can go back 10 years. So for those of you that, I will get into a little bit later, when we talk about your tuition credit continuity and making sure that it's properly been accounted for, you want to actually go back. For those of you that are dental students or just graduated, you want to go back and make sure that all the expenses are included. All the tuition credits are included. All right, next question here. Let's see. What happens if you make business expense by accident with your personal credit card? That's okay. If you have a professional corporation, you can still claim those expenses in your corporation, even though you paid for them using your personal card. Okay, that does happen. Think of it like a reimbursement. So, for example, if you were, let's say you were at a clinic and the front desk person, for example, they're working in the clinic and they go to the ODA convention and they pay for parking. So they paid for it themselves, right? So what would happen is they would come back to the office and they'd have the receipt and they'd give the receipt to the owner and they'd say, can you please, they'd reimburse them for that parking. So they would cut them a check. So that check would be tax-free to the employee and it would actually be deductible to the clinic as a business expense. Same concept applies if you're a self-employed dental professional corporation person, and then you paid for something on your personal credit card, you can still claim it in your business. You just have to account for it as a little bit technical. We have to account for it at what we call as part of your shareholder loan balance. So, we would usually take care of that as part of the accounting, but quick answer, yes, you can still claim it. Are meals with staff reps considered marketing as meals with colleagues and other dentists? Yeah, any meals and entertainment expenses that you incur in running your business, whether you're meeting with a rep or going to an event or with a colleague, those are not technically marketing, but meals. And meals are a special category in the Income Tax Act because only 50% of them are deductible. So when clients provide us with their meals in the office and we file their tax returns, we ask them to provide them with the total gross meals that they spent. And then when we do the tax return, and you'll see the demo, 50% of them will automatically be non-deductible. It automatically gets adjusted on the tax return, it gets carved out. So quick answer, yes, you can definitely claim anything that was business related. When you travel for a course, meals, gas, flight, course costs, do you bundle it all in one? Or do you have breakdown? Separate from flight. We like to break it down between the different categories because it just allows a better reporting in terms of what the nature of that was. So you probably could bundle it all as part of the course, depending on, I'm assuming it was all business, then it'd be a lot easier just to claim it under travel. I use Simple Tax, which fills things in automatically. Okay, great. What are the expenses that we can claim on our business credit card? Heard some people claim their car loans, which all gas purchases, while others can claim it if for purely business, which is the correct method. Actually, in the demo, I'm going to go through the example of a car expense, so you'll be able to see that hopefully later. But if I don't answer it later, please we can revisit that. How can I claim my out of Canada course attended Florida Dominican? Hopefully you receive some sort of receipt or document relating to that course, and you can claim it as part of your education training expenses against your income, assuming you're working. So the receipt should provide some evidence of the course, assuming it was a dental course. Question here, but even the income tax is longer because of the insurance take a long time to pay. Work done in the office doesn't get paid. It's always going to have some collection. Not sure. What it says here, but even the income takes longer because of the insurances take a long time to pay. Oh, right. I think you're referring to the accrued basis versus the cash basis. Yeah, exactly. Like one of the issues in the industry is like the insurance company doesn't pay. So you're always going to be chasing your tail trying to figure out what the income is. So could be very complex. Most people use the cash basis and take the advisement from the CRA website, which indicates that if you're an agent, self-employed, that you can use a cash basis. What if I take all my CERB because I forgot? Can we still claim it? CERB, no. CERB is closed. So if you were eligible for CERB and you didn't claim it, no, you can't go back and claim it now. It's the program has been canceled. So you can't go back. Expenses applies like we pay for 2020 OD expense in 2020. I just now keep it to when the payment was done. Right. So technically, if you paid for something in advance, then it would be a prepaid expense and only deductible when incurred. So for example, for those of you that are like a practice owner and you pay for your rent, last month's rent, that payment is not deductible until that actually last month happens. And same thing with the ODA. If the event occurred in the future, then it would be only deductible when the event happened. This year ODA is going to be virtual, but you still got to pay. So good question. Thank you for the session. It's a good idea to lease a car or finance. Presently, I am leasing a car. I'm going to go into that in the demo. I'm going to show you the difference between leasing and financing a vehicle. I'm also going to talk about quick summary about electric vehicles versus regular vehicles and how electric vehicles are, there's an advantage for that. Can I claim a disability and life insurance premiums as tax deductions? You can claim life insurance premiums as long as the beneficiary of the life insurance policy is, could be yourself, but it's required as collateral for a bank loan. So if you take a life insurance policy and the bank says, we're giving you money and we're only going to give you this money if you have this life insurance policy, and they're using it as collateral for the loan, then you can deduct the life insurance. Otherwise, life insurance, you cannot deduct it as a business expense. Disability is also deductible. However, if you claim disability as an expense, as a business expense, and then you have a claim, the claim will be taxable. So something to monitor there, but definitely included in your submission, and it's definitely something we can look at as depending on your personal circumstances and the amount of the disability premium, which can be sometimes high. So why not put certain meals under marketing so it's not 50% if it is for marketing? Just the only reason you can't put it under advertising or marketing if it's a meal is because of the provisions in the Income Tax Act. They distinguish between advertising and meals as two different categories, where the meals are deductible at 50% and the advertising is only deductible at 50%. Sorry, at advertising 100%. So the only reason you would separate it is because of the type of expense it is. So the 2021 RCDSO ODA license fee be considered as an expense for 2020 or 2021. The licensing fee, it will depend. You may have to prorate it. The ODA, I guess the event's in 2021, so you would defer it to 2021. Do you have to include CERB as part of your 2020 income? If you paid it back. No, if you paid it back, then you should be okay. Then there should be, when you received your T4A slip from the Canada Revenue Agency, there should have been a box showing maybe the income and then the offsetting deduction. So you shouldn't have to pay tax on it, just the net. Are gifts and gift card at 100%? Yeah, they could be at 100% as long as they're for business purposes. And I suppose if it was a meal gift card, that could be possibly 50%. So better if you buy the staff gifts than meals. Well, when you say staff, if you're a practice owner and you are buying gift cards, if it's a gift certificate or a gift cards, it's fully taxable to the staff. If you buy them something, so let's say you buy them an iPad and it's $500 or less, it's tax free. So you get to deduct it and they don't have to put into their income. But if you actually go to the iStore, Apple Store, and you buy a gift certificate and give it to them, then they have to include it to income, but yes, you can still write it off. So the short answer is you're better off just buying them the gift. If it's less than $500, it's tax free per employee per year. Okay, so those are the questions so far. Let's go to the next chapter. How and when should I incorporate? Okay, share screen, remote. Okay, so back to presentation. So, 1 second. How and when should I incorporate? So a couple of quick planning considerations to consider before you want to incorporate. You want to look at, looking at paying off your student loans and your line of credit first. If you're looking to buy a home, you got to take that into consideration too. In the decision, it's a very personal decision. You have to look at your family structure. So for those of you that maybe they're married and you have you're earning income, sometimes it makes sense to incorporate if your spouse is taking care of their the living expenses, because then you can incorporate, pay tax at 12% on your dental income, and then let's say your spouse is working full time, at a job, they can just use their money to pay for all the personal living expenses because they don't have any ability to write off all these expenses and they can't incorporate. So you would then incorporate, lock in your income in your corporation and take advantage of the lower tax rate and use that as a savings plan to invest. And then your spouse could spend their money on the living expenses. So sometimes it depends on your short-term goals, your medium-term goals, and long-term goals as when's the appropriate time to do it. Also have to look at, other considerations in terms of your personal living expenses, your lifestyle, how much you're spending. Because if you're spending all the money anyways, it's going to end up in your personal income ultimately. So hopefully you're not spending all the money and you can use the professional corporation as a savings vehicle and allow you to leverage buying and getting into investments and stuff. So a little bit of a personal decision depending on your personal circumstances. Can come up with a pretty good plan for it by navigating through an analysis of your personal statement of net worth and your assets and your current family structure. So quick planning considerations there. Now, this is a copy of a memo that one of our lawyer friends uses, and we use as well as the summary of the steps that are required to set up a corporation. So just some high level stuff. The name of the corporation has to meet the college requirements. So I want to make sure that the name is meeting the RCDSO requirements. The address of the registered office, we generally recommend that you don't use your home office as the business address. The different types of shares that you want to structure, you have to look at. We get involved in the structure of the corporation quite frequently in conjunction with your lawyer to ensure that the shares are set up in such a way to allow you to split income potentially and possibly take advantage of some other capital gains exemptions that are available if you're running a business to sell your practice. Your telephone number, fax number, email address all have to be confirmed on the incorporation setup. You'll have to open up a new bank account once you incorporate, and you would take the articles of incorporation to your bank account, open up a separate bank account in the name of the corporation. We usually recommend you open up a credit card as well, separately in the name of the corporation, and that simplifies your life a lot because then you can use your credit cards in the corporation and your debit card in the corporate bank account for keeping track of everything. It does simplify it a lot. You'll have to get a business number from the Canada Revenue Agency. The CRA will automatically issue you a business number and mail it to you. And that will be sort of like the SIN number or the ID number of the company. From that perspective, once that's done, then accountants will advise you on how you're going to be paying yourself as remuneration, as salary or dividends, and you may have to open up a payroll account. If you have any contracts as an associate, you want to make sure that those contracts are amended to include your corporation as the actual payee of those monies and not yourself personally in the records of the practice. So you have to inform your principals of that. You may even have to amend your associateship contract. Then you will also receive a certificate of authorization from the RCDSO once it's approved. There's a fee for that, which is $750. It's a one-time fee that's paid to the RCDSO when you set up the corporation. In terms of your disability insurance, you'll need to speak to your insurance provider about the change of your corporation. They may have to make some amendments to your policies to ensure that your income is clearly defined in the disability coverage, because now you're switching it to the corporation. All the income that you then earn will then be deposited directly into the corporation, and all the expenses will be paid by the corporation, like your car, we'll go into the details later of the different categories. Lawyers that we work with will prepare an employment agreement between yourself and the corporation if you are working as an employee for your corporation. Good news is if there's any excess funds in the corporation, they can be invested in the corporation as directly in the company, whether it's stock, bonds, mutual funds, or just cash. And every year you'll have to file a financial statement and a tax return with the government for that corporation, and our accountants, our office can advise you on that as well. If you are running a clinic and you're not incorporated for some reason, and then you incorporate, we'll have to file a special form with the Canada Revenue Agency to transfer any goodwill or any assets of your business to the corporation. And that's done on a tax-free basis. So we could help you with that. Accountants will help you with that. It's a special form called the T2057. It's a rollover, tax-free rollover to transfer all your assets. Most of the times, dental associates don't have to do anything for that because they don't really have too many assets built up, and they're not generating any goodwill potentially because they're working as an associate in the clinic, so they don't have to file that election. And the other thing that's important is that when you have a corporation, you should review your estate planning matters with respect to your will. You may be required, and it may be advisable to have two wills, one for your personal estate and one that dictates what happens to your assets inside the company. And we call that like a dual will, primary will or a secondary will. And the benefit of that is a secondary will, the one in the corporation, is not subject to probate in the event of if somebody passes away. So it's some of the things to consider when you're setting up a corporation. Now, in terms of the different structures that are available to you, you could have a sole proprietorship. So you're just an individual dentist and you're operating without a corporation. So relatively simple structure. You file your personal tax returns. It's a simple structure. You're subject to the high rate of tax, higher rates of tax. The high rate is 53.53%. Later on, I'll show you a grid with all the different rates. Or you could open up a corporation where you're the owner of the corporation. This opens up some more flexibility. You're eligible for the small business deduction, which allows you to have 12.2% combined corporate tax rate inside the corporation. In Ontario, for example, there's some flexibility because you can issue dividends to yourself as a shareholder. You're eligible for the lifetime capital gains exemption if you ever start a practice. So there's some flexibility there. Now in Ontario, for example, you can also add other shareholders to your professional corporation other than yourself. You can add your spouse, your parents, or your children. Other provinces have different rules, but in Ontario, this is a structure that we do see that the RCDSO allows. Again, just another example of another structure that is available through the professional corporation. Sometimes what happens is for practice owners, as well as dentists, they'll open up a second corporation, a real estate company, in addition to the professional corporation. And let's say you're starting up a practice or you have other real estate assets, you can put those real estate assets into a separate corporation independent of your professional corporation. And that allows for protection of those real estate assets independent of the corporate risks associated with running a dental practice. So this is a common structure that we do see. Sometimes when people start up a practice, they will have a separate corporation that owns the building where they run their practice. And then they have another corporation where they run their clinic. And then they have a lease agreement between themselves, their own company, and their company that's owning the real estate. So that these structural issues are things that come into play depending on individual circumstances and as things develop in a dentist career. Sometimes we'll see another structure here where they'll have their professional corporation, but they may have another technical service company that's doing hygiene, for example, which is owned by another family member. And then the benefit of this is both companies will be eligible for the 12.2% tax rate. And because that 12.2% tax rate is only available on income over $500,000 net per company. So it allows them to multiply the tax rate. So in some cases, you may see, if you're an associate, for example, and you're looking to buy a practice and you look at in a practice appraisal, you might notice, we were looking at one last week where they have two companies. They have one company that's the professional corporation and they have another company. But as part of the purchase transaction, they were looking at, buying both companies. So just to be mindful that it's not uncommon that you may see two or three companies within a corporate group. Here we have the 2020 combined federal and provincial tax rates. So in Canada, we have a progressive tax system, a marginal system. So in order to understand how this chart works, so the left-hand column is your taxable income, okay? So anywhere from $0 to $42,961. So between this range, the income tax rate is 20.05% on income. Income means working at a job like employment income or working like self-employed, okay? So between 0 and 42,000, some of that income is exempt from tax because of the personal tax credit that you get. So if you're making $42,961, for example, the amount of tax that you're going to pay is $6,319. However, on top of that, you're also going to have to pay CPP, Canada Pension Plan Premium, and EI, Employment Insurance Premium, if you're working as an employee. If you're self-employed, you would also have to pay $6,319 on that income, that net income, that's after your expenses, okay? Now, any additional income that you earn above $42,961 between here and here, okay? So think of it like a tax, we call them tax brackets, but it's really from this range to this range. There's a difference of about $4,000. Every dollar above $42,961 is taxed at an additional 24 cents, so 24.15%. So from $42,961 to $46,606, that additional dollar above that is taxed at an additional 24.15%. So then the tax increases to $7,199. So if you take the difference between this number and that number and multiply it by this percentage and add it to this number, that will be your additional tax that you would pay all in on that amount. And that would continue down this chart on these different tax brackets. The high tax bracket being $220,000. So any income over $220,000 net is taxed at 53.53% personally. So that's what we call a marginal tax rate system. Now you'll notice there's different columns because different income is taxed at different rates. So if it's a capital gain, so if you're investing in a stock, bond, or mutual fund and you buy something and you sell it, or real estate, like investment property, you'll notice that this number is exactly half of this number because only 50% of capital gains are taxable. That's why this number is exactly 50% of this number. Okay. Now, other income that you can also receive, for example, if you earn a dividend from your corporation, for those of you that already have a corporation, you'll notice the tax rates are lower than the income ones. And the reason for that is because the corporation is paying tax already. And you'll see that later in another example. But the corporation is paying 12.2% if it's a small business corporation, like a dental practice, or a dental associate practice corporation. This dividend, you'll notice, is lower. And the reason it's lower is this is dividends that are paid to you from like a company, like a publicly traded company, for example, like Bell Canada or large corporations, and they actually pay more corporate tax. So the dividend, when you receive money from them, it gets taxed at a lower rate. Okay, so that's just a general chart on the combined federal tax rates. Now, when you're incorporated, good news is you only have to pay tax at the 12.2%, not the higher rates on the income. So that's one of the advantages of incorporating. You get access to the lower rates. Now, that's the Ontario rate. Some of the other combined rates in the other provinces, for example, are a lot lower too. So depending on what province you're in, the rates could be a lot lower. So up to $500,000 in the professional corporation net, that means after expenses, is eligible for the combined 12.2% tax rate. So there's going to be an inherent advantage to having a corporation if you're not using all the money personally. Okay, just a summary. Okay, you're getting the small business rate, 12.2. It's actually 12.2% on the first 500,000. So there is a significant spread. Now, any income that you earn over $500,000 in the corporation is taxed at the higher 26.5% rate, just on that marginal incremental increase. Okay. Other good news, if you're paying a dividend from your corporation and you have no other income and you're paying that 12% tax rate, you can take out $35,000 out of your corporation without paying tax. And the reason for that is because the personal tax on that dividend is going to be about 8%. However, because of the personal tax credits and another credit that's available called the dividend tax credit, you don't pay any tax on that dividend. Okay. What else is here? Income splitting with your family members. We talked about that. Still possible in certain cases if shareholders are spouse grade over the age of 65, or if the family members are actually working in the company, you can actually still income split with your family members. And lifetime capital gains exemption. Another advantage of incorporating is you get a tax-free sale of your shares of your practice in the future if you are incorporated. Okay, setting up my business account. So for those, so now you've incorporated, you went to the lawyer, you got incorporated, set everything up, you got the bank account, you got the credit card, everything's good. Now I'm just going to show you another quick video about setting up your My Business account at Canada Revenue Agency for your business. The other one that we were talking about was for the personal. This one's a little bit different. Give me a second while I set that up. Let's see if we can get this to work. One second. Okay. This is also a great tool for you to have at your disposal if you are owning a corporation.
to register for My Business Account. To get started, go to canada.ca/my-CRA-business-account and select CRA Register. To validate your identity, enter your social insurance number. Next, enter your postal code or zip code, date of birth, and an amount you entered on one of your income tax and benefit returns from the current tax year or the previous one. Then, select a delivery method or a CRA security code, which is required to gain full access to My Business Account. Depending on the delivery method you have chosen, you will be asked to confirm your current postal code or zip code, or enter your email address. The next step will be to create a CRA user ID and password. Then, select and answer 5 security questions. Review and agree to the terms and conditions of use by entering your password and selecting I agree. If you have chosen to have a CRA security code issued via email, you will now be asked to contact the CRA. Registration is now complete until you receive your code. Once you do, log in and enter it. Review and agree to the My Business Account terms and conditions of use. Then provide your business number. You will now have full access to My Business Account.
Okay. Definitely something to have in your arsenal, access to your CRA My Business Account for those of you that are already incorporated. For those of you that are not incorporated, definitely keep that in your repertoire to-do list. And let me just go back to this guy over here. Okay, so yep, definitely want to get that all set up, right? Your CRA My Business Account. I just took a screenshot here. So once you're in there, there's so many different things you can do. And once you have the corporation set up, you can manage your address, you can calculate your installments, you can view the status of your return, you can view return balances, you can transmit a return, you can look at your account balance, how much money do you owe, you can file an objection with the government. This is the same type of screen that we see as the accountants of record when we do represent a client. Now, that's on the corporate tax account number. If you have payroll, you can also file a payroll report, view details of a return, of a payroll detailed return. You can set up your payroll account. You can close your payroll account. So there's different things you can do, and it's a great thing you can do. You can also check your online mail. You can get copies of your notices of assessment. You can make a payment as well. So definitely something you should look into having available for yourself as a business owner or operating a professional corporation. Okay. Chapter 5, let me just quickly go through the questions before we move on to that chapter. Let's see if there's anything else here. Can we add parents even if they don't stay in Canada? Yes, you can. There's no restriction on adding parents if they're outside of Canada. You may lose some tax benefits. You'll have to, depends on which country they're in. It can have tax implications to them. Definitely something to consider. We do have, our firm is affiliated with an international group of accounting firms worldwide. So if we need to get tax advice from a jurisdiction outside of Canada internationally, we can do so. Is doing a second real estate corporation later after the purchase or need to have it done at time of purchasing a clinic? We like to structure it properly from the beginning. It can become a little bit complex if you start transferring real estate outside of a corporation into another corporation after you've closed your acquisition, because then you have to pay land transfer tax on the transfer. That's one disadvantage. And it can also create some problems later on if you decide to sell the clinic and, for example, keep the real estate. Then you have to do a complicated tax reorganization, and it can create some problems. It's called a butterfly transaction. Fancy word for transferring a asset out of one company into another company. But if I had, most of our clients would advise them to have a separate corporation from day one. If you're an associate, can we add more employee in corp, and what's the advantage? Yeah, I mean, you can. If you're an associate, you can, there's no restriction on you adding an employee. I mean, you're running a business. It really depends on what are they doing and what services are they providing, but you can definitely add an employee. What the advantage would be is potentially for income splitting opportunities. I mean, the dentistry industry is quite dynamic, even for an associate, because a lot of associates are looking to open up a practice at some point and possibly start their own practice or buy a practice. And in the process of doing that, it's not unusual for them to be using the services of a family member as part of their search for a dental practice or their due diligence process. Recently, we had a client who had flown in from out of province, and it was actually the spouse that was coming on behalf of the dentist to investigate the purchase of dental clinics. And he was flying in, he was traveling all around the province, and he was looking at different opportunities. So if her husband, who was coming and doing all the due diligence, and if she wanted to pay him a salary, that could be advantageous to her if the husband was in a lower tax bracket or in terms of income splitting. So could be an advantage. Should it be, it says, should it be only dividend or mix of salary and dividends? What is more advisable? Heard you save more on dividends. Yeah, dividends can be a nice way to distribute income from a corporation because you don't have to pay CPP. So you save about $6,000 a year in Canada pension plan premium costs versus taking a salary. So definitely one advantage there, about $6,000. And hard to generalize on that. There's a lot of differences between salaries and dividends, where salaries are eligible for deduction in the corporation, where dividends are not. Dividends are taxed at a lower tax rate personally than salaries. Salaries are eligible for RSP, contribution room, dividends are not. So sometimes it's a decision that we do make in communication with our clients, depending on what's more optimal for them. And sometimes it can be a mix, as somebody had noted there, yeah, between salary and dividends. So definitely a personal decision, depending on your family structure, your personal income, and looking at your personal situation in terms of where you are in your career. Can the same person own both the professional corporation and also the hygiene service corp? Yes, they can. However, it may not be advisable if you're trying to multiply on the 12% combined tax rate, because there are rules in the Income Tax Act known as association rules, which prohibit individuals from owning multiple corporations and taking advantage of multiplying the $500,000 12% tax rate if they own more than 25% of the other corporation. So definitely a tax planning point, which you could explore in each individual circumstances. Okay. Can we add a sibling as a shareholder? No, not in Ontario and not in most provinces. But you can add them as an employee. There's no restriction on that. But you can't add them as a shareholder. For example, in Ontario, most provinces, siblings are not eligible for shareholding. Only for parents, spouses, and children. When I lease or finance a car, should it be named on my corporation? Or can I buy the lease on my name and deduct it because it's paying when you want to change the address or change the license plate number? If it's in a corporation name, what is common practice? Most of clients buy or lease on a corporation. Yeah, most of the time, if somebody calls me, they're usually at a car dealership and they're like, okay, the guy's asking me what to do. And usually I like it if it's in the corporation. It keeps it a lot easier and simpler rather than transferring it later. It usually doesn't cost additional money from the dealership's perspective. You just have to give them a copy of the articles of incorporation, and they'll register the insurance, and everything will be in the company, and the insurance rates generally are the same. It's a lot easier for accounting as well, because at the end of the year, in the accountant's office, or you're doing a bookkeeping, you're like, here's your corporation bank statement, here's your credit card, it's all in. We don't have to go do all the accounting. And then at the end of the year, we're reviewing your accounting. You're like, oh, what about my car? And they're like, oh yeah, got to get the car in. But then what happens is it just creates another administrative burden on like trying to chase down information that if it was already in your source documents, like your bank statements and credit card of your company, then it's a lot easier. So generally like to put it in the company. Is it better to pay the spouse helping with due diligence as salary or dividend? Depending on the spouse's income bracket, it could be beneficial either way. We could look at that on each individual's personal situation. Do you suggest buying your first house from corporation or personal? What are the benefits and limitations, short-term, long-term? Generally, we recommend purchasing the property in the personal name because in Canada, your principal residency is eligible for the principal residency exemption, which means that when you sell your house, there's no gain. The gain on the house, there's no tax on the gain. It's tax-free. Whereas if you purchase the house inside the corporation and it's your principal residence, okay, it doesn't apply to investment properties, then you got to pay tax on the in the company, even though you live in the house. So it can create some major problems and complications if you acquire the home in the business. Potentially there's a benefit because then if the house value was not to go up dramatically, which is, hasn't been the case in the last forever. So, but if that did happen, and you knew with absolute certainty that if you purchased a property for $1 million and you knew that in 5 years you're going to sell it at $1 million and you weren't going to have a capital gain, then you could buy it in the company, and then you would use your corporation dollars to pay the mortgage off. The only risk that you'd have from a tax perspective is that if the house value went from $1 million to 1.5, and then you sold it in the corporation, you're going to have to pay tax of approximately 26% of that 500,000. Whereas if you sold it personally, it would have been tax-free. Okay, so short-term could work, long-term, not the best. Spouse has no income. Going back to the previous question, they're asking about salary or dividend. Yeah, and dividend works out well in a lot of cases, as long as they're working and helping in the company. The government now requires that person, if they're getting a dividend, a family member, they have to be working at least 20 hours a week in order to be eligible for a dividend. If there's a difference between the date of RCDSP Health Corp certificate and CRA Business Incorporation date, which one should we follow? Okay. Technically, the RCDSO certificate of authorization is the date at which the company can start accepting income. Because prior to that, the dentist was not eligible to be operating in the professional corporation. So if I incorporated a company today, and or let's say tomorrow on February 22nd, and then I went to the college, submitted all the documents, got my certificate on March 1st, and then I opened the bank account. Actually, you could have opened the bank account before, but technically you're only allowed to receive the earn income in the corporation at the date of the certificate. So any income earned like in January prior to receipt of the certificate, let's say on March 1st, would be taxed in the individual tax return. And then after you get the certificate, right? Then you'd be personal. Then it'd be in the corporation. Can a parent own the Hygiene Technical Service Corporation if the dentist is single? Yes. There's no, see, the Hygiene Technical Service Corporation is not regulated with the RCDSO. So it has no restrictions on who can own the shares. So that can create a whole slew of planning opportunities. And most of you have obviously seen the changes in the market in terms of private dental service organizations and how they're structuring their affairs through technical service corporations and the whatnot. Right now, I'm paying my student loan in full, whatever I'm earning monthly. Okay. Aggressively paying it off. Is it the right way to do so? Also, so no money left in professional corporation. I have an corporation account, can show loan from corporation. Will it be more beneficial to have a corporation set up? I guess it'll depend. I could look at that. It'll depend on how much is the loan that you have remaining and how much money you can keep in the corporation. And if there's number three, if you have any income splitting opportunities to maybe mitigate your tax on the withdrawal of the funds from the professional corporation. Oh, I see, you haven't incorporated yet. So in those cases, it tends to work out okay if you just pay off the loan with the money, because you're going to take it out anyways. The only thing that would mitigate that would if you had income splitting opportunities and could take out the money from the professional corporation at a lower tax rate. So that may depend on your family structure. Okay. When do you find associates, not practice owners, see it worth it to incorporate? Is it usually a salary benchmark? If the answer is too convoluted, don't worry. When do you find associates? Usually after they've used all their tuition credit carry forward balances, after they've paid their student loan, and they are sort of in that level where they're still earning high level income and they don't have the tuition credit available, and they may have some income splitting opportunities, then you're looking at usually around second year after graduating. I'm going to go through an example as well to show you an example of somebody who had graduated in 2014 or 15, and then trajectory of how it all played out. I don't know you are allowed to buy a house with your corporate money. Yes, you can buy a corporation. You can buy a house with corporate money. It's not illegal. It's fine. It's a real estate, not a problem. But it just may not be advisable depending on the plans, right, for that corporation. Okay, let's continue on the journey. Utilization of mechanics of tuition credits in Canada. Okay, here's an example. A dentist graduated in 2014, started associating summer of 2015. Let's just say 2014. Dentist, yeah, it's probably 2014 he started. Dentist has a bunch of $125,000 in federal and provincial tax credits. Dentist earns between $225,000 and $250,000, 2015 and 16 as an associate. Then they incorporated later on. Okay, so this is just an example of what you would see when you log in to CRA. You see your tuition carry forward continuity schedule, all the way going back from undergrad, potentially, and then dental school. And then you see here, looks like they graduated in, and then this may not be a complete amount. I think they may have used some of their tuition credit before because they were working, but at the end of 2014, when they graduated from school, they had $125,000 of tuition credit, federal and provincial. And then they used a little bit of it in 2014 because they started working in 2014, kind of like in the summer, and then they still had $115,000 of tuition carry forward left over, and they were not incorporated. And then in 2015, they utilized the rest of it. So they had nothing left. Okay, so this is a simple example. So on their personal tax return in 2015, they were not incorporated. So they had $226,000 of income. 2016, $253,000 of income working as an associate. And they had their various expenses. Now, same case, you'll see 2015, right? And 2016, when they were associating, this is their personal tax continuity, like a historic schedule. You see in 15 and 16, see in 15, it says it's 169, right? So that 169 is the net after the expenses that they reported. That's their income. They made an RSP contribution. They claimed the tuition credit. They had some donations. They had some other credits. They paid tax of $25,000, okay? That was the year where they had the final balance of their tuition credit. Then in 2016, they continued to associate. They did not incorporate for whatever reason. They paid tax on $170,000. That was their net after all their expenses. They made another RSP contribution. They were thinking about buying a house at the time. They wanted to maximize their RSP contribution. They got a deduction for that. Deduction means it was deducted from their income. 171 minus the deduction, minus the CPP they paid. Now, because they had no tuition carry forward left over, if you're sitting down, if you're standing up, you should sit down, because they paid $49,682 in tax. This is an actual case. Then they didn't like that. So they incorporated a professional corporation. This is a financial statement of that corporation. So that corporation continued to, now they incorporated a company. They opened a bank account. They opened a credit card. Now they're earning money inside the corporation, and they still got to write off all their expenses. Corporation only paid $14,000 of tax in 2017. Corporation only paid $25,000 of tax in 2018. They distributed some money out of the company to themselves. Now in 2017, they were in transition because they incorporated in December of, where was it? 2016. The incorporation late December, but they didn't, going back to that other question, somebody earlier, they said, well, if I don't have the RCDSO set up, or, so they had there was a delay. So some of their income was reported on their personal return in 2017, and some of their income in 2017 was reported in their corporation, because there's a delay between the time they got everything set up. That was okay. So they reported some income from the self-employment as well. And then they also reported a dividend, because they took some money out of the corporation at the time. Made a small RSP contribution, purchased a home. By that time, he had paid back all his student loans, right? And then he's like, okay, I'm buying a house now, planning to get married, kind of thing. So he paid $19,769 in tax in 2017 in the personal, plus $14,000 in the company. So quick math, 14 plus 20, that's 34,000. So a little bit less than this 50,000. Then in 2018, he was fully incorporated for the whole year. So he had his full, associateship income, wrote off a bunch of expenses. Company paid $25,000 in tax. Okay. But he needed money personally. And then he took out $95,000 as a dividend, some tax credits, and then he paid $7,157 in tax on his distribution from the corporation, plus the company paid $25,000. So his total tax burden in 2018 was 25 plus 7, which is about $32,000. Again, a little bit better than paying 50,000. So there's mechanisms and vehicles and structures available for you to take advantage of your tuition credits early on, navigate through the system to build through, make the RSP contributions, buy your first house, use that as a, get the home buyer's amount credit, use the home buyer's plan to use those RSP contributions early on, and then set up the corporation later on and take advantage of the lower tax bracket. Okay, that's a little bit of a update on that. Let me just quickly check and see if there's any other questions. RCDSO, okay, when do we find associate? I don't know, you're allowed to, I did that. The spouse getting dividends with zero income, be helping with due diligence, you mean they should have worked 20 hours a week for the weeks you are paying them, but not necessarily for the whole entire year of 52 weeks, right? Weeks you are paying them. Yeah, you could, I guess it depends on how much the dividend is, but yeah, I think you got that right. Principal residency, capital gains exemption, is there a cap? No. So if I buy a house for, let's say somebody bought a house 30 years ago for $100,000 and they sell it today for 5 million, it's tax free. Okay. Are you able to take a loan from the corporation to purchase a property? Yes, in certain circumstances you are. There are provisions in the Income Tax Act that allow somebody to borrow money from a corporation if they meet certain requirements. They're very particular requirements. I can summarize them here for you. One of them is there have to be bona fide terms of repayment. There has to be a prescribed interest rate, the CRA prescribed amount. It has to be at a byproduct or a byproduct of you being an employee of the company, not a shareholder. It has to be available to all employees. Mm-hmm. So there's a few restrictions on doing that. You have to be mindful of those, and you have to structure it properly, and you have to be careful that you're doing it so it doesn't get deemed to be a taxable benefit or deemed to be income to you. So definitely something to look at, but definitely need to make sure that you speak to an advisor to structure it properly so that you don't get into a situation where it gets deemed to be income, because you're basically pulling out money from your corporation to buy a personal property. I'm assuming you mean personal property. If you're taking a loan from the corporation to purchase an investment property, then you don't have to take the money. You can just buy it in the company. My spouse is also a dentist, and I am a dentist too. Do I have option of income splitting as we both are earning the same yearly? I'm paying my student loan aggressively. I asked you question earlier, am I eligible for income splitting? Yeah, with spouses, there's definitely there's a flexibility in income splitting because you're both working. So hopefully I answered your question. You are eligible for income splitting, yeah, because you're both dentists, right? So that makes it a lot easier. In cases where the spouse is not a dentist, that's where it becomes a little bit more complex. But when you're both there, and you'd have to look at the numbers to see how much money you're taking out to pay for that student loan, because you said you're paying the student loan off aggressively, to get a better feeling for the mechanics of it. But definitely it looks like you should be on the right track because both of you are dentists and you can income split. How do tuition credits work? Hopefully I answered a little bit of that in the previous chapter, but happy to weigh in if you need more, if you have more questions. Chapter 6, what can I write off? Okay, so on our website, we have this worksheet, which you can use to help you. It's in Excel and in PDF, fillable PDF as well. And it kind of summarizes all the different expenses that are available for dental associates. Advertising and promotion, we talked about a little earlier, meals and entertainment. Bad debts don't really apply that much in the industry, but that would be if you, let's say, for example, you included income in your return, but they didn't pay you. later, then you could write it off. It doesn't happen that often. Insurance, life, disability, critical illness, depending on the criteria and the type of policy, could be deductible. Bank charges, interest that you're paying on any lines of credit, credit card fees in the business are deductible. RCDSO fees, ODA fees, any subscriptions, licensing, so, you know, software subscriptions, courses that you're taking are all deductible. Office expenses, if you have any, you know, if you do a home office, you may have a computer or a laptop or something like that. Dental supplies, if you're paying, some dentists will be buying their own PPE. They have their own, you know, specific needs for PPE, for example, or shoes or something, or they're buying certain supplies. If they're a specialist or something, they can deduct it. Legal, accounting, other professional fees, courses and whatnot, you can take as a deduction. Management and administration fees, if you're paying a family member to help you in the business and they are self-employed and they're issuing you an invoice, you can deduct a portion of that. Rent, if it's if you have a clinic or you're renting space for some reason for some lab work or something, you could deduct that. Maintenance and repairs, if there's any loops break and you go repair them, you know, it's, for example, if you're paying salaries or wages to a family member, if you're an associate, obviously if you own a clinic, it'd be deductible. Dental instruments costing less than $500 are fully deductible, 100%. Anything over $500, they just go into a different category where they're deductible at a over a 3-year period, approximately. Travel expenses, including cars separate, but if you're like traveling for business, telephone, internet, utilities, delivery, postage. If you're paying health plan premiums, a portion of them could be deductible in certain circumstances through the health and welfare account, or there's ways of structuring your healthcare premiums and your medical costs to allow them for a deduction. If you're paying for lab fees, professional development, meaning courses or CE, home office expenses, dental, conventions, and seminars. So for the car, here's a quick list of the categories that are eligible. Fuel, repairs, parking, insurance, licensing, leasing, ownership of car, Canada, you know, Canadian automobile insurance, for example. Sorry, Canadian Automobile Association dues. You also have to document the business kilometers you drove and the total kilometers driven, and these numbers will be prorated based on the business usage. Home office expenses, for those of you that are using your home office partially for work, you can claim all of these expenses and they get prorated by the total square footage dedicated for the office, divided by the total square footage of the property. Or you can also use another method, which is a number of rooms. So for example, if you have 3 rooms and one of them is used for home office, depending on the space, then you could deduct 1/3 of these costs, okay? If you're running a practice, for those of you who are thinking about buying a practice, expenses are a little bit more categories, but this is just an example of the percentage of each expense of the total production in a clinic. And it just gives you an idea of some of the different categories. And a lot of the categories are the same that they would be if you're an associate, but they're just a little bit more, you know, there's a little bit more going on, I guess you could say, in a clinic. Okay, so that is always a hot topic because there's so many different categories, and everyone's always wondering about maximizing this one over here. Let me just double check and see if there were any questions before I go on to the next section. Okay, 1 second. Over here, where were we? Screen share. Oh, okay. Principal residence. There's no cap. We got that. Got that. Hello, are clinic shoes eligible? 1 second. Clinics? Yeah. Yeah, I think so. If you have a special shoes or uniform or equipment or gowns or, you know, clothing that you're using in your business, then it's fully deductible as an expense. How about health spending account? Yeah, health spending account. We didn't get into too much detail there, but there is a mechanism available where you can use a health spending account, which is essentially I call it like sort of a privatized healthcare plan for yourself. And there's ways of administering it where it allows you to deduct all your medical expenses, prescriptions, chiropractor, dentistry, other medical practitioners as a deduction in your company. There's a little bit of a setup involved to do it, but definitely something that's available to talk to. A lot of times it gets structured through some of our insurance agents and brokers that specialize in dentistry that we deal with, and they will help set that up. Where can I watch your past videos? We have a YouTube channel. I'm going to be posting the old videos of our other videos on our website, and we're just branding a special website right now called dentalaccountant.ca, which is currently being developed, and all our resources will be available, and videos will be available for that site as well. Will these lists of expenses be included in your link? Yes, if you go on our website, you'll see all the expenses there. You just download the PDF Excel document and they're all there. Just go to the resources section of our website and you'll see all those stuff available for download. Hi, Atul, what do you think we can... Oh, yeah, Tracy, I know, it's going crazy. Time is an issue. Already went over time. Too many questions. Okay, let me see. We're already over time. Hopefully everyone can still be keeping a little bit over time today, but I'm going to try and run through the rest of it. And I think that's fine. We'll go to the rest of the questions after. That's fine. And we're going to run through the rest of it. TFSA, we talked about earlier. You know, for those of you that were, depending when you turned 18, you can contribute to your TFSA. Maximum amount is $75,500. It's tax-free, right? For investments, great opportunity. It depends when you turn 18, because if you turn 18 after 2009, then you don't get these contribution limits as you go. So you got to check your room, and you can check on your CRA online account. So now you know how to do it. RSP deductions. For those of you that are working as associates, you're able to make that RSP contribution. Like we showed that example of somebody had done it in the past. So you want to make sure you maximize on that, get those deductions and those contributions in before March 1st. If you need any help with that, you can reach out, and we have a wealth management department, and we can help structure your RSPs here as well. Home buyer's plan. Those of you looking to buy a house, and if you make an RSP contribution, you can use 35,000 of it towards buying your first house, and you don't have to pay tax on the withdrawal, because otherwise, if you take money out of your RSP, you got to pay tax on it, right? So definitely want to look at that program for those of you first-time home buyers. Also, if you bought a house in 2020, you get a $750 rebate back from the government, which is great. You just got to report it on your return, and you can claim a $5,000 credit, which equates to $750 back in your pocket, as long as you just disclose on your return that you bought a house and it was called home buyer's amount. Stock market trading. So just wanted a quick intro here. I actually am involved in a stock option academy training course every month. I teach the tax component of, and for those of you that are interested in taking an introductory course on stock option trading, and this is just a quick overview of some of the things that we talk about in the course, just send me an email and I'll give you some information about how to register for that. It's a full weekend course. The next ones are March 6th and 7th, but we do it every month. I run the tax chapter, but the other sections, which are summarized here, are all run by two of my friends and colleagues from school that teach the course. And it's a hands-on course teaching you, it's for beginners. And I teach the accounting and tax component, but there's a great opportunity here for those of you that are interested in stock option trading and learning about a strategy on how to navigate the stock market and earn money on your investments. They go through some examples of some trades. I talk about some tax stuff, talk about capital gains, how things are structured. We go through an example of how to structure different put option contracts to take advantage of different, and we also show you how to do it through your personal name and through your corporation, and how to possibly be eligible for the lower tax bracket as well. So reach out to me if you're interested in something like that. We're able to send you some information about that course. Next one's on March 6th and 7th. It's a live 2-day Zoom call course, but very hands-on. How much money can I expect to make after graduation? Chapter 11. Okay, so if you're associate, you know, sky's the limit, but usually caps out at about 300,000 because there's only so many hours in the day. And the big range is because some people, they start, you know, it depends on their schedule. When you buy a practice, start up a practice, again, a big range really depends. If it's a startup, might be on the lower end at the beginning, but then, you know, you can make anywhere from $750,000 to $1 million a year when you own your own clinic. And then later on in your career, if you get into multiple practice scenarios in real estate, pretty much sky's the limit too. Anywhere from $250,000 to $2.5 million a year is attainable, depending on your structure and number of practices and real estate holdings. When should I start looking for a practice to buy or start up? This is just a quick summary. I wanted to put some information in here about, for those of you looking to buy a practice, look at the ODA economic report. It'll give you some information about the location that you're in, the demographics of that location, very important in the buy process. And the market and the valuations of dental practices are actually increasing during the COVID-19 pandemic because of the nature of it being an essential service, and a lot of private equity money looking for yield, meaning return on their investment. So the valuations are up. So for those of you that are looking for the CE credits, please email Ms. Lulu Jiang at our office, and she will send you your CE credit. I'm going to, I know we're a little bit over time, but I am going to run a demo right now of a personal tax return for 2020. Okay, and then we'll get to the questions. Hopefully those of you that are still here can attend the demo, and then I can finish off with the questions, okay? So here is an example of a demo tax return. Clark Kent, Dr. Kent, married, put his address, Toronto, Krypton Avenue. He's married to Lois Lane, and they're both, you know, dentists. So one of the big sections that first thing you're gonna file is the 2125. The 2125, so let's say you're a associate dentist. So you're gonna file the 2125, Statement of Business or Professional Activity. So you're gonna put the North American Industry Classification Code, you're a dentist, when you started working, the address of where you operate, the main product or service that you're in, dentistry. You don't necessarily need a business number at this point if you are operating as a dentist personally. You can run this all through your social insurance number. You only need a business number if you are operating an independent business and you have payroll or you're collecting HST. And HST, dentists are exempt from HST, so they don't need a business number. So you don't have to get a business number. Now, if you incorporate, your corporation will need a business number in order to identify itself. So you'll have to get a business number. But if you're just operating as an individual Clark Kent dentist, doesn't need the business number to file the return. So it's 165,000, it's using that as example, total income. And then you'll see down here, here's all the expenses, right? Advertising, meals. But see how meals, if I put 4,000 in here, it only takes 50% of it as a deduction because it automatically carves out 50%. because under the Income Tax Act, they only allow 50% of the meals to be deducted. Advertising, the full amount. Insurance, interest, business licensing membership, RCDSO, ODA, office expenses, stationery supplies, legal and accounting fees, rent, all the different expenses we went through in the previous example are still there. Salaries, travel, moving, utilities, telephone, internet. The car is a different category, different schedule. So let's say they bought a Tesla, 2020, purchased it. How many kilometers did you drive? Well, if they drove 20,000 kilometers and let's say 18,250 of those were for business, then 91% of all these expenses are going to be deductible. I love how they put electricity here finally. So for fuel, because it's a Tesla, you don't have propane, oil, or gas. You're going to have electricity costs. So you have your electricity costs, which will be, so whatever we put here as expenses will automatically get prorated by the percentage that's used, depending on the percentage that you use the vehicle for business in that particular year. You may have 2 vehicles or 3 vehicles, depending on if you switched vehicles in the year. Now, in terms of the leasing costs, the maximum amount that you can deduct for leasing costs, you have to put the date that the vehicle was started the lease, okay, and then the total amount that the lease expense was. So so let's say $12,000 they spent on leasing for the year. It's $1,000 a month, but there's a limit. So the government only allows, does it apply here? The government only allows $800 plus tax, $904 per month as a maximum leasable deduction amount for a lease. So if you're paying $1,000 a month, you're only allowed to claim the $904, okay? The program will calculate it automatically and also prorate it for the business usage. Now, if you buy the car, you don't lease it, then there's a separate section where you would claim the cost of the car, $100,000. Now, what's interesting is that in 2020, if it's a zero emission passenger vehicle, the base increases to $55,000 that you can fully deduct. Or if it's just a regular car, you can only maximum you can deduct is $30,000 for the car. Okay, and there's some accelerated amortization that's allowed. That's why it bumps it up to 45. But the key thing to know is that you can't deduct the whole amount of the car in that year. Only 30% of it. Or if it's a, regardless of whether it's a electric vehicle or a regular car, you're still only allowed to deduct 30% of it in the first year, which actually works out to be 15% because they have this thing called the half-year rule. But the point being that you can only deduct a portion of the vehicle against your income if you buy it. So there's a separate schedule for the car expenses, right? Going back to the form here, then you got all your expenses, you know, private health service plan premiums, all those other expenses. Now, for a dental associate on the Schedule 11, they're going to have their tuition credit carry forward amount. So in this particular case, they had $165,000 of income and they had all their expenses and they're getting taxed on $129,000. On their personal return, they're only paying tax of $8,000, which is zero federal tax. $5,796 of CPP and some provincial taxes kicking in. The reason they're paying so low tax is because they're eligible for the tuition credit. If they didn't have any tuition credit, because let's say they used it all, then their tax would go from $8,000 to almost $38,000, because they don't have the tuition credit anymore. So the tuition credit can be a very good thing, but it doesn't work out dollar for dollar. So for example, the net is 129,000. That's the net income from the $165,000 associated income minus the expenses. But if I go to their, if their tuition credit was, let's say 125,000 federal and provincial, it doesn't act as a deduction, it acts as a tax credit. So see here, they're getting the $125,000 tuition credit, but it's in a separate category called federal non-refundable tax credits. So it gets added to, somebody asked it earlier, the question before, what are the personal tax credits that everyone gets? 13,329. Clark here is getting another 13,329 because Lois has no income. So he gets to claim the spousal credit for her. She was on sabbatical. So that $13,000 credit plus the spouse had no income, another $13,000 credit, 26,000. Another credit for CPP that he paid, and adding the tuition credit. So what happens is it's a 15% coupon. See, it's fixed. So the total of all those credits get multiplied by 15 cents, and then you get a non-refundable credit. What does it mean? It's like a coupon. It's like a discount on your taxes. So he had to pay $24,000 of federal tax, but then he got this number got carried over here. It lowered his federal tax to only $1,700. So on his actual return, he only paid $1,700 of federal tax to the federal government because of the, so it doesn't work dollar for dollar. It's not a deduction. A deduction is something different. A deduction is something over here at the top part of the return, name, address, phone number, married, not married, you know, are you a citizen? Yes or no? You know, all the questions. You own any foreign property. But the way the deductions work is, here's your income, okay? I mean, the tax return, step 2, total income. So this whole section here, all the way down to here is what's your income? Different types of income. Employment income, CPP, old age security, whatever. You know, some people are gonna have CERB income this year. And then this number here is the difference between the gross associative income and the expenses, which was from the other form. It carried over. The other form we did, which was the T2125. Here's your income, here's all your expenses, net number carries forward after the car and everything. There's your 129, right? There's your 129. That's your income. Now, from your income, there are deductions. So this step number 3, all this section here are different deductions you can claim. Things that you didn't claim already over here. Okay, so what are those deductions? RSP deduction. Let's say Clark made an RSP contribution at a bank. Let's see, he did it today, because the RSP deadline, as we know, is the end of March, end of February. So let's say today he made an RSP contribution of, and assuming he had RSP contribution room, which you can check on your CRA My Account, so you know how to do that. 10,000, right? Let's assume that he had RSP room because he was working part-time during undergrad, etc. So now, second 20. Made a contribution tomorrow. So now he made the contribution. Should be able to. Should be, then he'll be eligible to claim the deduction The reason it's not being applied is because he already has the tuition credit. But if he didn't have the tuition credit, it would kick in. For example, should kick in here. Let's see. How come it didn't kick in? 50,000. Make sure that my care. Yep, that's fine. That's good. This is good. Where's my deduction? Well, I'm carrying right now, but here's my 20,000. So he would get the full deduction. So the deduction, in addition to professional dues, but you've already claimed the professional dues on the other section, so you don't have to claim it. Childcare expenses. So let's say the person has a child, then they can claim up to $11,000 per child, depending on when they're born and their date of birth, as a deduction. Okay, it's directly deducted from the income. Moving expenses. For those of you that moved to go to work, you can claim. There's a whole section here. Where did you move? What was the distance of the move? The only issue is that move has to be more than 40 kilometers from one to the other. It could be because you were changing your work or going to school, and you can claim those as a deduction. Okay, so that's something to look for. If you paid interest on some investments or got some investment course or advisory that you took, you can deduct interest paid on investment income. Let's say you borrowed money to invest in the stock market, you can claim interest against your income. So all of these items, they actually get deducted from the tax return prior to calculation of the tax. Whereas the tax credit is applied later. Let me just put back in the tuition. The tuition credit gets applied down here. Okay, so hopefully that's a little bit of a mechanic for those of you that are associating right now, and this is the first time you're filing a tax return with income on it. You know, your income is probably going to be around, I don't know, 75 grand maybe, depending on how busy you were during the first 6 or 7 months of working, and you're going to have all your expenses. Well, what's going to happen is your tuition credit's going to kick in, hopefully. Now, for those of you that, let's see here. You're still going to have to pay CPP though. So what's going to happen here is that if your net income after your expenses is greater than about $60,000, you're still going to have to pay $6,210 in tax on April 30th, even though you're not paying any federal or provincial tax other than $750 as a healthcare premium, and you have to pay the CPP of $5,796. You still have to cut a check to the Canada Revenue Agency of $6,210 before April 30th if you're an associate that earned more than net about $60,000, even though you had the tuition credit, which is, where's the tuition credit? It's down here. The tuition credit only gets utilized up to the point you're not paying any federal or provincial tax. I mean, it says $750 here. Reason for that is technically, it's not really income tax. It's the Ontario Healthcare Premium. And the Ontario Healthcare Premium is based on a grid system. So depending on what your income level is, you will pay the maximum amount of, in this case, it's $750 because the income is between 72,000 and less than 72,000. If you make more money, then you still have to pay the healthcare premium, about maximum 900, but no federal tax. Why is there no federal tax? because the tuition credit kicked in, coupon kicked in, coupon was enough to cover the tax. Tax was 14,000, credit was 14,000, no tax. Still has to pay the CPP though. Okay. So hopefully that is some good information for everyone. Let me go through the questions before we wrap up this session. All right. Final hurrah. Let me see what we have here. Healthcare premium. Can I include a luxury wristwatch as an expense? Maybe. You know, it was I remember the ODA economic report from I think it was about 3 years ago, and it was talking about speed and how the speed of the dentist can be critical to the amount of earning that they can make, and how beneficial they are in terms of their earning potential. It said speed matters. So if you want to test the speed, you may have to use a watch. But I'm not sure about the luxury part, but definitely something to look at. I mean, a lot of times with cars, phones, computers, you know, you could buy a laptop. You could probably buy a used laptop for like $50, but you could also buy a laptop for like 10 grand. So it's still a laptop. So it really depends on, you know, a question of scale. The term luxury, there is no limit on certain items, but like for vehicles, they do have limits, okay? Can whole life insurance paid from incorporation? Yeah, like definitely can, your whole life policy, definitely beneficial for it to be paid from the corporation. I think it's a great idea because you're using low tax dollars to fund a policy. If you're running a clinic, we don't generally recommend that you buy the policy in the clinic because it can become a problem later on when you try and sell the clinic. And then we have to transfer the policy out of the company, and we can do that, but it can be a taxable event. So because the policy may have generated accumulated value, especially a whole life policy. So definitely be mindful of that. I have group health benefit insurance. How much can I deduct the premium? Yeah, you can deduct the premium. There is a section for that in the tax return to allow you to deduct your healthcare premium either as a medical expense or as a business expense. And I think that's also how to get access to the. How do I get access to the recording? I am going to try and post that on our LinkedIn or possibly our YouTube channel. So I'll keep you guys posted on that. Question here, when you say meals at 50%, is that personal meals or even when you take other people out and entertain them to increase the business? No, it's technically the other way around. If it's a personal meal, like if you go to like the grocery store for like dinner at your house, then it would be not deductible. But if it's a business entertainment meal or you're at a clinic and you're going, you know, at a project, then it would be business, that'd be deductible. Okay. Is driving from home to work and back home considered as a business expense? If you're an employee, it's not deductible. If you're a self-employed individual, you have to look at it like you're essentially a business owner and you're going to a project. So when you're going from home or your home office to the clinic, and a lot of people will work at multiple clinics, so they may be driving like all over Ontario, for example, they can deduct the kilometers to the clinic and back to their home office. You know, you can use that. We actually have an automobile log on our website as well. I think I promised I was going to show you guys that too. Maybe I'll do it at the end. I'm associating for 2 years. You showed buying office will earn more money, like up to 750,000, but as managing office after over at the end of month. So it wouldn't be less money at end of month in clinic owner, but we'll be paying a mortgage. How will be earning? You show in the chart showing 3 to 5 years as owner, like cash flow and corporation. Yeah, it's all over the map when it comes to when you buy a clinic. It depends on the location, the number of operatories, the system that the clinic has that can change the dynamics of the cash flow that's generated. It can be very difficult for some clinics to generate positive cash flow when they're in a very competitive environment or location, and depending on the size of the clinic. So that chart was a little bit of a, that's why there's such a big range between, you know, small number and big number, because it really depends on, you know, we've have some clinics in Northern Ontario where there's a big shortage of dentists that do super high cash flow, because they are able to benefit from that. The fact that the clinics have no competition, not as much competition, so it's easier for them to generate higher cash flow. But in the city of Toronto, it can be a little bit more challenging, and you have to be, you know, you have to be, it depends on the location, especially during COVID-19. For example, there were some clinics in downtown Toronto that were maybe in the path, and they were relying on people working downtown and taking GO Train and TTC and all that stuff, and they're paying high rent in the underground, but they're not getting the benefit, right? So it really depends. But next question, could you show the email for CE again? Yes, I'm going to show that right now. Okay, thank you for that. Lease or buying a car. We're thinking actually about writing an article just on that topic because it's so dynamic, but feel free to reach out to me if you have any specific questions. Should car financing loan be paid from the corp or personal? I like to just dump everything through the corp. It's a lot easier. It keeps everything in one spot. And then when we're doing your accounting and stuff, it's just like simpler to have it in one place. Once you're an owner of a clinic and the clinic is considered your office, and then you can no longer claim the travel from home office to work. No, not necessarily, because you're a business owner. And as a business owner, in the Income Tax Act, you can still deduct your travel expenses going from, you know, and as a business owner, sometimes you're going to meet with suppliers, you're going to your accountants, you're going to your lawyers, you're going to your bankers, you're going to your insurance agent. You're also maybe looking around for clinics and expanding your operations. So it's not unusual for a professional dentist to be utilizing a vehicle for business expenses as part of their business. So question here, do you help to buy a dental business? Yeah, absolutely. We do have many projects where we have been involved in helping with the due diligence of buying a dental practice. We actually have a webinar that we recorded that I can send to you, which talks about the process of buying a dental practice and the due diligence that's involved and the process that we use to do a chart audit, as well as the financial due diligence in setting up the business. So happy to help out with that. Let me just get that last question about the CE course. You know what, let me post it on the chat so that you guys have it, which is for the CE credit to contact. Share, see if this works. To everyone. Does that work? Oh, sorry. There we go. You can email Lulu Jiang at our office, and she will email you your CE course certificate for the Sunday afternoon. Went over time, sorry about that. Hopefully we'll do some more stuff, and thank you for being here, everyone. I think I got, oh, and then for the course, the options trading course, I will send you right now the link. Where is it? I'll send you the link to the website to register for that. We are taking new registrations for that as well. And we'll go from there. Thank you everyone for having me. It's been a great experience, hopefully for everyone to learn about some tax stuff. Happy to help out doing tax season as well. For those of you, let me just send you this. Everyone meeting. There's a link to the trading course. It's a Theta Trading Company. Two very good friends of mine, Matthew Todman and Omar Khan, run the course. I run the tax portion, and 2-day online trading course. Thank you everyone for having us. If you need any more help during tax season, please reach out. For any private consults, reach out to me, and I will just share screen one more time. There's the course content, the website for the trading course. And if you want to reach out, please do so. Here's my contact information for private consult. Thank you everyone for being here. Thank you everyone for having me, and enjoy the rest of the weekend. Cheers.
Cash flow to revenue.
better hold on to that spot you got because there's much more so and much more fun to come after station identification with the fabulous Al Green and the mighty Impressions. Look out now for the OJs coming out of Philly with a showdown. Give the hits called For the Love of Cash.
No need to worry, my accountant handles that. No need to worry, my accountant handles that. No need to worry.